for argument's sake, you're in a cash business, right? You do some sort of business that involves a lot of cash. Well, they still haven't figured out how you can deposit cash digitally, right? So you got to go to the bank and do that. Now we know that they don't take your money and physically put it in a little box that says CJ's money, but we almost kind of think it's that way. And the reason I say that is because they're leveraging every dollar every day until you spend it. Perfect example. Let's say the average family in America makes $5,000 or $6,000 a month, okay? And their bills are maybe $4,000 or $5,000 a month. They're fixed expenses, and they spend an extra 100, 200, 300, 400, $500 a week on going out to eat, on entertainment, on Starbucks or whatever the case may be. So they only have maybe a few $100s a month really left net, $200, $300, $400 maybe. Very typical of an average American family. Well, what we don't realize is we think that's how banks make money. We think, oh, well, what difference does it make if I really make any interest on that $200, $300, $400? It's not that much. That's not how banks make money. They're making money on the entire $5,000 or $6,000 you deposit every single day, it or a lower remaining balance of it exists in your account till you spend it, which is why 93% of all bank accounts are in non-interest bearing accounts. Now, just get your mind around that for a second. And then on top of it, we're paying for the privilege for them to use our money, right? Whether it's a 10 or 15 or $20 monthly fee. And then, of course, if there's any other ancillary fees associated with it, we're paying them for the privilege to leverage our money. So I want to introduce a really powerful concept today to your viewers, and that is we want to start teaching people how to get out of loanership of their money and start getting into ownership of their money. So checking accounts are just one example, right? When 90% of people are putting money into an account that's sitting there waiting to pay bills, but the bank is leveraging the use of that money every single day until you spend it. What about people who have escrows, let's say tax and insurance for their mortgage? Now, in many cases, you don't have a choice. The banks are setting it up that way because they are protecting the consumer, when in reality, they're leveraging the use of every one of those dollars, and they're only paying that property tax once a year. They're paying that homeowner's insurance once or twice a year. How much interest do you get on that account? Zero. What about those people this time of year that are filing their taxes? And they're going to be so excited when they get $3,000, $4,000, maybe $5,000 tax refund. Well, all that really means is that they overpaid on their taxes, and the government used that money all year. And CJ, how much interest did they give you for the privilege of them using your money? Zero. So again, we become conditioned, unbelievably conditioned and hardwired to loan our money to everybody else because they're the experts and they'll be so much more responsible with our money, instead of understanding how we can fundamentally turn the tables on that process and become owners of the money ourselves. A couple of very, very big and important principles there. So again, volume and velocity, how much money, how fast, and how many times can they leverage that same dollar over and over again, never having stagnant money. And there's 4 other primary principles. There's dozens, but we'll say the 4 primary ones. Number 1, strategic payoff is one of the things we focus in on. It's what to pay, how much, and when. Secondly, it's interest float. Now, most of us understand that concept basically just in terms of maybe having a grace period on a credit card or something. But then the other one is interest accumulation, pretty simple one. Up until recently, savings accounts were only paying, 0.5%, 0.25%. Now a lot of them are paying 3-4% more. Well, now interest accumulation becomes a factor. But here's the one, CJ, that almost nobody truly understands, and it's interest cancellation. How are you actually canceling out interest that you otherwise would have been scheduled to pay? Now, even apart from the velocity banking strategy, where we're actually leveraging the use of that money and the way in which the interest is calculated, the reason that these two concepts come together is because it's not interest rate as much as it is how the interest is calculated, how the finance charges are assessed, and how and when the payments are applied. That's what determines true interest volume, or the amount of effective interest you're actually paying. So the average person, let's say in a traditional car loan, student loan, installment loan of some sort, or a mortgage is a perfect example. There's many people that think, well, I've got a 2, 3, 4% interest rate. That's so incredibly low. And it is by historical standards. But one of the things that every single one of your viewers should do is take their current mortgage statement, separate the escrows, right? Those are billable expenses you have no matter what, independent of the debt. and take the amount of interest you're paying and divide it by the entire payment. And the number you're going to get is going to be mind-boggling. You're going to see that that loan is actually costing you about 60, 70, sometimes 80% or more in interest volume, which means 60 or 70 or 80% of every dollar you pay is going right to the bank that you will never see again. And it's not going to the bank of you. You're not redirecting or leveraging that money that is providing a financial benefit to you. In a traditional mortgage, as an example, we think of that as being historically the lowest rate, but it actually ends up being the most expensive. And it's not just for the reasons you think. Yes, it's typically the largest loan. Yes, it's typically the longest term, but it is because of the way that they calculate the interest. Because amortization schedules on a mortgage are not based on payments as much as they're based on balance points. So when you can accelerate into the future at a different balance point, you now permanently cancel every single payment, principal and interest, you otherwise would have had to make to get to that point in the future. So here's a super simple example. Right now, obviously, the average home in America is 300,000, and loan amounts vary. And yes, rates now have gone as close to 7-8%. Now they're back in the 6 and 7s. There was time they were in the 2s and 3s. But believe it or not, across the board in America, the average loan is right around $200,000 because there's some people have had a loan for many years. The average rate is still right around 6% because of newer loans, because of people that didn't refinance. Across the board, across America, there's a big blend. But let's say on a $200,000, 6% mortgage, the average person is going to pay back $331,677 in total, which means they're paying nearly 150% back on the money they're borrowing. Now, we tend to think, well, that's just the way that it is, right? Well, let's say as an example, you paid $5,000 to that balance one time. Maybe you got a tax refund. Maybe you got a bonus. Now, of course, you're going to lower the balance from 200 to 195. That part's pretty simple. But what people don't realize is that now you accelerate to that point in the future where that amortization schedule would be at 195, which meant all those little payments it took principal to get to that point are now permanently eliminated, which means you've now canceled about $20,000 in roughly 2 years worth of payments with one $5,000 payment. Now, ask yourself the question, if you gave me $5,000, CJ, and I gave you $20,000 back, how many times do you think you'd want to play?
Infinity.
Every day and twice on Sunday, right?
Yes.
Now, we don't have an unlimited access to just random $5,000 tranches. That's true. But we do have access to ways in which we can leverage that money using other instruments, i.e. revolving accounts. So as a closed and fully amortized loans, we can leverage other things that are revolving, that are open-ended. And that just has to do with the way in which the payments are applied. So let's use a simple example. Let's say, for argument's sake, one of your viewers here had a 6% mortgage, right? Maybe just a little bit less than what many of the rates are now. A 6% line of credit, first or second position, or they have a car loan and a 6% credit card. Now, on the surface, they all seem the same, don't they? But they only appear that way. In other words, it's not interest rate. That's the note rate. That's what just simply determines your payment. It's how the interest is calculated, how the finance charges are assessed, and how and when the payments are applied that actually dictate the true debt service cost. In other words, how much it's actually costing you in total interest volume. And that number is entirely different. And most people really don't understand that. But let me tell you who does understand that very well. Obviously, it's banks and financial institutions. Again, we're not bashing the financial institutions. They exist for very important reasons. But it's all about emulating what works. It's all about being able to put into play and deploy similar systems and strategies that banks have been using for, as we said, decades, but to our advantage instead of the banks. Very, very powerful stuff, CJ.
Man, that's amazing. Okay. So, I wrote down a couple of things here.
Okay.
Leveraging interest, interest float, leverage and interest cancellation, that point that you made about 200,000 at 6%, coincidentally, There's a reason why, folks. Now you know why I'm always, when I talk about mortgages, I'm always using those same numbers,
Mhm.
200,000 and 6%. Now you know why, right?
Right.
So yeah, we're taking in all of the mortgages and the averages. We're making sure that we have that good round number there.
Mhm.
150% back, man. So what that means to me is that interest is interesting, right? So how true interest costs